Welcome to vTalkInsight, Allocator's Lens Daily for December 4, 2025. Across assets, the story right now is a powerful mix of expected Fed rate cuts, an AI-driven Capex boom that is reshaping both growth and bond supply, and a U.S. yield curve that is steepening even as equities push higher and volatility drifts lower. Let us start with equities, where stretched valuations are colliding with improving market breadth and a much more global opportunity set. In equities, the headline picture still looks benign, with the S&P 500 index edging up over the past week while volatility indices grind lower. Underneath that calm, allocators are weighing very expensive valuations, a powerful but uneven AI Capex story, and signs that leadership is finally broadening beyond a narrow group of mega-cap technology names. The central question is whether earnings and global growth can justify today's multiples if the path of Fed easing or AI monetization disappoints. Valuation is the first tension point. The S&P 500 is quoted around 25 times earnings, and the equity risk premium is described as roughly in line with the 10-year Treasury yield, which limits the compensation for taking equity risk. At the same time, this has been a very good year for global stocks. Europe is reported up close to 28%, Asia about 27%, and emerging markets around 23%, helped by a weaker US dollar. That performance, combined with the index-level re-rating, means allocators are increasingly focused on where incremental earnings growth will actually come from over the next couple of years. AI remains the dominant equity theme, but the narrative is maturing. On one hand, demand for NVIDIA-style chips is said to exceed supply by roughly 12 to 1, and large technology firms are projected to spend $3 to $4 trillion on AI build-out over the coming years. Enterprise adoption is still at an early stage, with estimates that only about 3% of U.S. companies have deployed AI, and order backlog metrics at major software and cloud providers point to strong underlying demand. On the other hand, current estimates suggest each dollar of generative AI investment is only generating about 20 cents of return, versus more than $1 in the early cloud era, and some recent earnings from AI-exposed names have highlighted slower than hoped adoption or cautious guidance. That mix supports the idea of a long runway for AI-driven growth, but also raises concerns about overinvestment, margin pressure if software pricing has to come down, and the risk that some of today's enthusiasm proves ahead of the revenue curve. One constructive development for allocators is evidence of broadening market leadership. Recent sessions have seen most S&P 500 constituents advance, with energy, financials, industrials, and consumer discretionary stocks outperforming while the largest technology names lag. There are signs of a K-shaped U.S. consumer, where high-end shoppers keep spending and mid-income households trade down, which is showing up in better performance for discount and value retailers, and weaker interest in staples and food producers perceived to be under margin pressure. Individual stories support this rotation narrative, from an apparel retailer that has more than doubled since May on stronger guidance, to off-price chains lifting their earnings outlooks, and to defense companies that report strong order books despite softer share prices. Looking out to 2026, some investors expect earnings growth to broaden further into underappreciated sectors, reducing concentration risk even if the overall number of listed companies and the dominance of large tech remain structural features. Geographically, there is a clear push to diversify beyond the US AI complex. International quality equities in places like India and Hong Kong are seen trading at a meaningful discount to broader indices, and client positioning shows a striking underweight to Chinese stocks, with US exposure reportedly many times larger. Efforts to build a more unified European stock exchange, and the fact that Europe has been a major supplier of savings to the US, highlight the potential for capital to be recycled back into local markets if liquidity, technology, and listing conditions continue to improve. Cross-asset linkages matter here. Expectations for Fed rate cuts, and the possibility of the 10-year yield drifting toward 3.5%, are seen as tailwinds for rate-sensitive sectors such as housing and financials. Systematic rebalancing mechanisms, like target date funds that buy equities when bond prices rally, could further amplify flows into stocks if the easing narrative holds. Against that, softening labor data, persistent affordability pressures, and the possibility that markets are overpricing the extent of Fed cuts all mean that today's equity valuations leave little room for disappointment. As a result, allocators are watching upcoming consumer earnings, AI monetization metrics, and central bank communication very closely as they think about where equity leadership goes next. Turning to rates, the message from the front end of the curve is that investors expect a decisively more dovish Federal Reserve. Markets are pricing a high probability that a new Fed chair perceived as favoring lower interest rates will be nominated, and futures imply a rate cut as soon as December with additional easing next year. That pricing has been reinforced by softer labor market indicators, including a notable miss in private payrolls and decelerating wage growth for both job stayers and job changers, which together suggest cooling momentum and some relief on wage-driven inflation. However, the case for aggressive cuts is far from settled. Inflation is described as still running around 3%, above the Fed's formal target, and there are open divisions within the central bank between members focused on price stability and those more worried about employment. Some analysts argue that the U.S. is more likely to experience a slowdown without a sharp recession, which would limit the scope for sustained easing. These cross-currents are visible in the yield curve, where the 2-year yield has fallen below 3.5% while the 30-year sits near 4.74, and the steepener trade has regained momentum. The long end is being driven less by near-term Fed policy and more by term premium, fiscal questions, and a wave of capital spending tied to AI and industrial policy. Looking ahead, several forces point to more volatility at the long end of sovereign curves. Large asset managers are positioning underweight long-dated treasuries into 2026, citing the risk that heavy AI-related Capex and government deficits will push up term premiums and require sustained issuance. At the same time, some sovereigns are choosing to issue more short-dated debt, potentially to avoid locking in higher coupons, which lowers immediate supply pressure at the long end but increases refinancing risk over time. There are also fiscal and legal overhangs, from potential court decisions that could force tariff refunds and worsen the deficit, to debates over extending healthcare subsidies. Despite these concerns, there is a view that strong global demand for treasuries and the U.S. reserve currency role could still allow yields to drift lower into 2026, even as the distribution of outcomes for growth and inflation widens. For multi-asset allocators, that means the front end of the curve may continue to act as a policy and liquidity barometer, while the long end becomes the primary channel through which AI Capex, fiscal policy, and global savings imbalances are expressed. In credit, the surface still looks calm, but there are growing questions about how much compensation is left in spread products given where we are in the cycle. Many fixed-income investors are prioritizing income and diversification, but are reluctant to move materially up the risk spectrum because spreads remain tight and corporate fundamentals, while solid today, are unlikely to improve indefinitely. Some portfolio managers are explicitly paring back credit exposure, rotating toward treasuries for duration and liquidity, while maintaining allocations to real assets such as gold and uranium as additional diversifiers. A key fault line is the interaction between AI-driven investment and corporate balance sheets. The AI build-out is fueling strong demand for financing, yet there are already signs of strain at individual issuers. Credit default swap spreads for a major software and database company, which has been aggressive in AI-related Capex and bond issuance, have pushed to their highest levels since the global financial crisis, highlighting market concern about leverage and execution risk. More broadly, some investors are taking a contrarian stance on investment-grade corporate debt, pointing to tight spreads, expectations of heavy issuance tied to AI spending, and the sense that the big duration tailwind from falling yields may be behind us if growth and inflation stay elevated. Private credit sits at the intersection of these themes. On one side, loans backed by infrastructure and productive Capex are seeing strong demand and attractive risk premiums, reflecting the need to finance energy transition projects, data centers, and manufacturing reshoring. On the other, legacy acquisition finance structures are facing more pressure as higher rates bite and outdated capital structures meet slower growth, raising restructuring risks. Some commentators argue that core, well-underwritten private credit is being unfairly lumped together with riskier leveraged lending, and note that several high-profile blow-ups have involved bank-originated loans rather than the heart of the private credit market. Into 2026, the base case in the commentary is that solid corporate balance sheets and ample liquidity should support the asset class, but that dispersion will increase, particularly around AI-intensive business models and highly levered capital structures. For allocators, that tilts the emphasis toward understanding issuance pipelines, sponsor behavior, and covenants, rather than relying on index-level spread measures that may understate underlying risk. Foreign exchange markets are echoing the cross-asset pivot away from pure U.S. exceptionalism toward a more balanced global picture. The U.S. dollar is reported to be down roughly 7% year-to-date, and there is active debate over whether this marks the start of a more structural move lower after a long bull run. Several forces are at work: expectations of easier Fed policy as U.S. labor data softens, signs of recovery in Europe and parts of Asia, and the prospect of a Bank of Japan rate hike that is already supporting the yen. The euro has appreciated, but central bank forecasts suggest limited impact on headline inflation because current price pressures are driven mainly by services, reducing the currency's influence on policy in the near term. Meanwhile, a major Wall Street bank expects the Chinese renminbi to appreciate gradually on the back of better trade outcomes and robust exports, with authorities seen as comfortable with a bit more currency strength. Digital assets add another layer to the FX story. Legislative momentum in the U.S. is picking up, with bipartisan work on defining digital asset securities and clarifying jurisdiction between regulators, as well as plans for innovation exemptions that could ease access to public markets for crypto-related businesses. Stablecoins in particular are seen as gaining political backing, with some expecting the market to reach $2 to $3 trillion over time, cementing their role as a permanent fixture in the financial system. Institutional demand is also visible, with large asset managers highlighting the growth of long-term Bitcoin holders and the potential for tokenization to cut friction and costs across markets. Yet there is a clear note of caution. Commentators warn that expectations of Fed cuts are boosting risk appetite more than underlying crypto fundamentals justify at this stage of the cycle, and that the recent downturn may have further to run. The proliferation of zero-day options, perpetual futures, and prediction markets is also blurring the line between investing and gambling, prompting regulators to block new high-leverage products and raising broader questions about market stability. For allocators, the combination of a softer dollar, shifting policy differentials, and fast-moving crypto regulation suggests FX and digital assets will remain important transmission channels for both monetary policy and risk sentiment. Commodities, and energy in particular, are undergoing a structural reset that feeds directly back into inflation and growth assumptions. Despite a double-digit decline in crude oil prices this year, the energy sector is described as resilient, helped by strong demand for U.S. liquefied natural gas exports. In Europe, natural gas prices have fallen for several consecutive days, and declines along the forward curve are already easing inflationary pressures, with the potential to further support activity if sustained. Policy is reinforcing this shift. The European Union has committed to ending its reliance on Russian gas by 2027, while simultaneously ramping renewables by about 40% over 3 years and re-embracing nuclear power in some countries. A surge in global LNG supply from Canada, Qatar, and Australia expected by 2026 could tilt the gas market from seller-driven to buyer-driven, putting additional downward pressure on prices. At the same time, energy remains tightly bound to geopolitics. Diplomatic efforts around Ukraine have delivered limited progress, and debates within Europe over how to use frozen Russian assets underline the complexity of securing long-term funding for Kyiv. A durable peace agreement would likely deliver a positive supply and demand shock for Europe through lower energy prices and stronger growth, especially in Central and Eastern economies, but the path to that outcome is uncertain. There are also live trade tensions between Europe and China, including over electric vehicle tariffs and the supply of critical minerals and rare earths, which highlight ongoing dependencies in industrial supply chains. Policymakers warn that simply swapping dependence on Russian gas for dependence on a single alternative supplier or technology would leave energy security risks unresolved, arguing for a diversified mix across fuels and regions. From an allocator's perspective, the evolving balance between lower headline energy prices, persistent geopolitical risk premia, and large-scale investment in defense and energy infrastructure will be key to the medium-term outlook for inflation-sensitive assets across the commodity, equity, and bond markets. Stepping back across assets, the current landscape combines equity markets near highs and improving breadth, a front end of the rates curve priced for a dovish Fed and even a potentially more accommodative chair, and a long end increasingly driven by term premium, AI Capex, and fiscal questions. Credit spreads remain tight even as individual stories around leveraged AI investment and legacy private deals show more stress, while the dollar has softened on narrowing rate differentials just as crypto and stablecoins move toward a more regulated, institutional phase. In commodities, Europe's rapid shift in gas sourcing and renewables investment is easing near-term inflation pressures but leaves energy security tied to geopolitics and supplier concentration. For allocators, the main watch points are whether Fed cuts come through on the scale now priced, how quickly AI investment converts into earnings and productivity, and how the yield curve and the dollar respond if growth tracks closer to the strong official forecasts than to the softer labor data. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.